Today we're going to be having a look at an ETF from Kevin O'Leary, who's also known as Mr. Wonderful, and you might know him from Shark Tank. Now, whether or not you're a fan of Shark Tank, you simply cannot ignore Kevin O'Leary because he brings so much spice to the show. He's very upfront, pretty direct, pretty ruthless at times as well, and just thinking about being on the receiving end of that is pretty crazy, and this makes the show pretty interesting. Now, he's basically gone ahead and founded a company called O'Shares ETFs, and as the name suggests, they offer a bunch of ETFs, and the ETF that we're going to have a look at today is the OGIG ETF. This is the Global Internet Giants ETF. Hey guys, my name is Fyzee and this channel is about finance and investing. Before we get into it, this video is absolutely not financial advice. Please do some own research of your own as well if you want to invest in this ETF. This is simply based on my findings, so make sure to do your own due diligence as well. Let's get into it. So as I said before, OGIG stands for Global Internet Giants ETF. Now the whole focus of this ETF is to invest in new technology that's constantly innovating rather than old technology that's basically lagged behind. And one example that I can give you guys is the tech crash of 2000, basically the dot-com bubble crash that you guys may have heard about. And the companies that crashed during that period, pretty much all tech companies, but the companies that recovered after that period were companies that actually kept on innovating, had strong balance sheets, strong financials, and companies that tried to delight their customers as much as possible. And the companies that failed basically did the opposite of that. So in a way, this ETF is basically trying to predict who are the potential winners of today and future winners of tomorrow, and essentially align the portfolio and the holdings to ensure that in the future these strong companies can thrive even more. Now this is a more selective approach to investing because if you think about technology as a term, it's a pretty umbrella term, it's a pretty broad term. It basically includes any company that has any sort of technology in them that are trying to do any sort of tech activity, so it's a pretty broad term, and not every single company in the tech space is going to be a winner. And since technology includes basically every company, the aim of this ETF is to find those chosen few companies that are going to have those big returns and that are going to be hopefully sustainable moving forward. Because if you think about the tech industry as a whole industry, you're going to have some companies in there that are going to have just average growth, some companies that are going to outperform quite insanely, and then some companies that are actually going to decline and even crash into the future. So the aim is to find those chosen few top companies. And the tagline for this ETF is so fitting, and I think it just encompasses everything that this ETF is about. And it basically says, access the internet giants of today and the potential giants of tomorrow. And this sums it up greatly because they're trying to find the companies that are going to grow from the digitization of the global economy. From stuff like e-commerce, which is growing very rapidly around the world, and digital innovation as well. Now looking at some rough metrics for the ETF, we can see that the revenue growth is 40%, so that's over 1 year, and that's pretty insane that the whole portfolio has grown by 40% if it was the aggregate of all those companies combined. Now it's very important to note that not every single company in the ETF holding has had 40% growth each. That would be pretty insane if it did. It basically means that if the ETF provider has used a weighted approach, you'll get to 40% if that makes sense. So basically what that means is that if a company has had a 100% growth over that 1 year period, but the weighting of that company is only say 1% in the overall portfolio, then it's going to be weighted accordingly and all the weights are going to be added up. And if you add all the weights, then 40% is the revenue growth that you arrive at roughly. And that's not really bad at all considering 40% is quite an insane number. Looking at the 2020 performance for the ETF, it is 107%, which is again pretty insane. It's basically more than doubled in value, which is a huge return considering that the market didn't even go up by that much around the world. So it's pretty impressive. The S&P 500 only went up by about 16%. That's just capital return, of course. But looking at the comparison between the S&P and this ETF has gone up by about 6.5x times the S&P 500, which is pretty insane. Now that's all well and good. However, do have a look at the comment down here, and I've basically zoomed in and you can have a look that it says that extraordinary performance is attributable in part due to unusually favorable market conditions and may not be repeated or consistently achieved in the future. So basically what they're trying to say is that 2020 was an anomaly. It was an insane year where the market crashed, 30%, 40% in just a month, and then subsequently recovered very quickly in the next coming months afterwards. So that was a very unusually uncommon year, and because of that, the insane growth happened in the ETF because most of the companies benefited quite greatly from the lockdowns and whatnot. And you can basically see that this was a perfect storm for the ETF because everything was shifted online. Schools were doing online learning. universities had online lectures, work had remote work obviously, and everything just went online. People were using social media more, watching Netflix, watching movies online, so it just makes sense. So basically what this means is that you can't really expect returns like that in the future. It was just a one-off return, but looking at it ahead, if the technology sector does seem to do well, this ETF may be outperforming the S&P once again, but who knows, past performance does not guarantee future performance. Now speaking of returns, let's have a look at some more in-depth returns for the ETF, but before we do, if you guys have found any sort of value so far, please leave a like or subscribe. It really helps out. Let's get into it. So looking at the year-to-date return, it is just around 2%. The one-year return is quite good at 35%. And having a look at the absolute maximum return for the ETF, it is 119%. So as you can see, it has had pretty good growth. And having a look at sort of the recovery period from March 2020 to the highest point, it's gone up by nearly 200%, which means that it's basically 3x'd in that period. And if we extend that period until now, the return sits at 150%, so it's not bad by any means. But it's also important to note that these crazy returns also come at a cost, and the cost is volatility. So if you guys have a look, having a look at the highest point until now, the ETF is down about 13%, and having a look at the highest point year to date to the lowest point year to date, the return is like negative 25%. So you can really see the insane variance, and the overall market has not declined by that much at all. So this ETF, since it's pretty concentrated, you can expect to see up and down movements like this, which are pretty wild in nature. And just for fun, if we compare it to the S&P 500 index, we can see that year to date is actually 20% positive, whereas the year to date for this ETF is 2%. So you can see that it's not a small difference by any means. It's actually pretty massive. It's varying by about 10x, which is pretty crazy. Looking at the one-year return though, it is mostly similar. The S&P 500 is 32%, whereas OGIG is 35%. But once again, if you have a look at a 5-year time horizon, the ETF outperforms quite significantly because the ETF time frame is since 2018. It's 120%, whereas for the S&P 500, 5 years is 100%. So even on like a 3-year time frame, the OGIG ETF is outperforming over that sort of period. So why should you invest in OGIG? Let's hear it from them, not me. So basically what they're trying to say is the whole focus of OGIG is on new technology versus old technology, right? So they're trying to find the most innovative and fast companies that are basically positioning themselves quite well into the future. And that's obviously what I mentioned at the start, because tech is a huge term. There's thousands of companies, and it's important to find the right ones that can outperform in the short to medium and hopefully long term as well. And the ETF has a global portfolio of around 80 stocks, mostly weighted towards the US as usual, as we all know with this technology sort of stuff, but they do invest globally, as we'll have a look in just a second. The other focus is on the quality of the companies, and what I mean by quality is the focus on companies that have proper financials, strong balance sheets, big growth prospects and whatnot. So the companies have to have a good potential, but they also have strong financials to back up those plans that they have, because a lot of companies have these insane projections and these insane sort of things that they want to do, but they don't have the financials to back it up. So the focus is on quality along with prospects as well. So having a look at some holdings for the ETF, we've got the usual names, the usual suspects: Alphabet, which is Google, Amazon, Microsoft, Alibaba, Tencent, Facebook, and some other names as well. Snapchat, Shopify, and Zoom. So of course, these companies have grown quite a bit ever since the pandemic as well. Zoom has had insane growth, and same with Shopify as well. Now, one thing that I found interesting is the holdings list does not include Netflix at all. I thought Netflix would have been added in here, but for some reason they have not been put in. So that's pretty interesting. Now, the holdings list also includes a couple of cybersecurity companies as well, like Zscaler, Fortinet, and some other names too. And they also include Xero, which is an accounting company based in Australia and New Zealand. So it's a proud Aussie moment to see this company being added into this list. Now, if you are looking to invest in a company like Xero, I've done a full in-depth review and analysis on the company too. I've gone into the company's prospects, their overall business plan, their financials, and my personal opinion on the stock as well. If you're interested, check out the video right here. There should be a link somewhere here. That video will basically go into all those details. Lastly, having a look at the sector and the country allocation, we can see that 40% weighting is towards IT. That's pretty common. Obviously, it's a tech-based ETF, so we are going to see this sort of allocation. Then we have about 31% towards communication, then 30% towards consumer. So we can see that it's pretty kind of evenly laid out. It's 1/3 each, kind of. And with the country allocation, we can see that it mostly leans towards the US at about 64%. Then we have China at about 18%, UK at 4%, Germany, Israel, a few other countries from Europe. And of course, for China, it includes companies like Tencent and Meituan and Argentina is here as well, which I found pretty interesting. You can see that New Zealand is here too at 0.77%, and that's basically due to the allocation towards Xero, because Xero is originally a New Zealand based company, but they've also listed on the Australian Stock Exchange. So that was the OGIG ETF. Definitely an interesting one for sure. I had no idea that this ETF existed until a friend of mine actually brought it to my attention, so I had to actually make this video for sure, because Kevin O'Leary is quite a celebrity, and it's pretty interesting to have a look at what his company has to offer in terms of investments for retail investors like us. Now, in terms of buying this ETF, you can actually buy it through any broker that has access to the US markets, but personally, if I was to buy it, I would be using Stake, because you can buy this ETF completely brokerage free using their platform. So if you do want to check out Stake, you can have a look at the link in description, and you and I can both get a free stock for using their platform. So it's basically a win-win for us. Go check it out if you're interested, but once again, it's an affiliate link and you can use any broker that you want to use. Personally, I'm not going to be investing in this ETF for now. I'm still going to be doing some research on my end, but let me know if you're interested in buying this, because I'd love to know. Now, if you're interested in looking at some tech-based ETFs, you can check out the video right here. This is the FANG ETF, which is one of the top performing ETFs of the ASX. It's had insane growth, and you can also check out NDQ, which is the Nasdaq 100. These two are both relatively tech-based ETFs. Check these two videos out, and guys, thank you so much for watching. Please like and subscribe, and I'll see you in the next one. Bye now. So looking at the